Good afternoon, everybody, and welcome to our very special edition of what you've come to know and love as the Corporate Governance Week. This year, due to COVID, it's our symposium, where over the next 2 hours, we'll be tackling the all-important questions about COVID-19, the future, and not just the short term, but obviously corporate governance implications in the long term. Today marks the start of a week long of various topics that we'll be addressing for you, including issues such as board diversity, how to deal with crises. And while you're sitting there on this Zoom call, chances are you have also been Zooming with your customers, with your suppliers, partners, maybe shareholders. Of course, the digital age brings with it a whole range of data. The question is, are you doing enough with it? And you'll find the answer in the program when we discuss this topic on Friday. But to kick us off today, we're going to be getting an overview of this issue, which as recently as a year ago, none of us could have, of course, predicted. What's the bet? Everybody was scrambling to their business continuity programs as soon as the crisis hit and found them to be deficient. Corporate governance, of course, is at risk of falling by the wayside as companies try to pick up their operations and just survive, even though now is arguably precisely the time that corporate governance ought to be your focus. So in a few moments, I'll introduce our various speakers who between now and 5 o'clock Singapore, Hong Kong time, in other words, in the next 2 hours that you'll be hearing from. For now, though, he's already on screen. David Gerald, founder, president, and CEO of SIAS. Good afternoon. Welcome to the show.
Good afternoon, Matt. Well, Mr. Ong Chong Tee, Deputy Managing Director, Financial Supervision at MAS. Mr. Carmine Di Noia, Consort Commissioner and Deputy Chair of the OECD Corporate Governance Committee. Mr. Greg Metcalfe, Director for Financial and Enterprise Affairs, OECD. Distinguished speakers and panelists, ladies and gentlemen, thank you all for taking time to join us today at the SIAS Corporate Governance Digital Symposium 2020. I would like to extend a very special thanks to Mr. Ong Chong Tee for taking his time to be with us as guest of honor. I want to thank Mr. Carmine Di Noia from Italy, Mr. Greg Metcalfe from Paris, both from OECD, for your participation once again in our Corporate Governance Conference. We are also happy to have with us in the audience Mr. J.Y. Pillay, an outstanding Singaporean, distinguished honorary member of SIAS, currently Rector College of Alice and Peter Tan, National University of Singapore. And thank you, sir. And Dr. Ang Hak Seng, Commissioner for Charities and Deputy Secretary of Ministry of Culture, Community and Youth, a friend of SIAS. It is indeed good to see so many of you joining us today, despite the challenges and disruptions that COVID-19 has brought us. Understand there's about 460 people out there watching this. It is with this same spirit that we decided to continue to hold this event digitally. COVID-19 and corporate governance, identifying right risks. COVID-19 has thrown a curveball to many industries and companies. We can expect the effects to linger for a few years to come. However, you may ask, what's the relevance of COVID-19 to corporate governance? Many feel that corporate governance is just a set of rules that we must reluctantly follow, focusing only on the burden and cost. They fail to see the real value of having proper governance in place. I see corporate governance, specifically integrity, as a foundation for company purpose, strategy, opportunity, and risk management. It enhances the quality of leadership and decision-making and confidence in all stakeholders. We need to use the lessons that the COVID-19 pandemic has taught us and start looking at the right risks, meaning climate, biodiversity, loss, natural and human-made environmental disasters. Therefore, the theme for this year's symposium is balancing short and long-term business pressures. Some of us will find that in the new normal business models will have to be changed and reviewed. Competencies of companies and staff will have to be gained and adapted. However, there is a need to change our priorities and start by identifying the right risks. There is no point arguing over shareholder versus stakeholder value while we continue to destroy the conditions for life on Earth. CG practices during COVID-19. COVID-19 also brought about particular challenges to companies and shareholders, especially in the context of shareholder engagement and the running of AGMs. For some time now, SIAS had been calling for virtual AGMs. I'm glad how swift the regulations were amended to help accommodate the need to conduct meetings virtually. However, many shareholders lament on having to only vote by proxy and submitting their questions to the company in advance. There has been no live voting and Q&A. While companies and vendors found themselves adjusting to a new normal, I'm glad that new guidance by MAS, SGX, and Ministry of Law on live voting and Q&A will be required for meetings henceforth. One particular observation we are pleased to note is how companies have responded to questions on their annual report posted by SIAS. From April to September, out of 217 companies, 153 responded to the questions. That is a 74% response rate, up from 20% before. I'm certain shareholders appreciate the efforts of companies keeping them informed, especially in the current uncertain environment. Corporate governance research. This year, although we will not be holding our annual Investors' Choice Awards, we continue to track listed companies on their transparency and corporate governance practices. In the interest of time, I will provide a quick overview, but the full details will be published on our website. The average overall corporate governance scores continued its upward trend and reached 52.8% in 2020 over a 4-year period from 2017, led by big cap companies at 68%. Whilst the mid and small cap also saw improvement, they trailed below the average. Broadly, the main driving forces for the increases are as follows: shareholders' rights and equitable treatment, responsibilities of the board, and stakeholders' roles. However, we are concerned of 3 critical areas. Only 4.6% of companies disclose that their board set the risk tolerance and that there was a risk management policy describing the tolerance for various classes of risks. 23.9% of companies disclose their key risks and how these risks were assessed and managed. And thirdly, 30.2% of companies disclosed their key risks and how these risks were assessed and managed. Given the current COVID-19 pandemic and the added stress and risk, companies are faced with the lack of a risk management policy and guidance of risk by the board, how the board can result in mismanaging possible opportunities while underplaying potential threats. In addition, more companies should disclose non-financial information. From our research, 85% of respondents use non-financial information for their investment decisions. New business integrity research. To further extend our evaluation of corporate governance practices in Singapore and the region, I am pleased to announce that in collaboration with CGIO of National University of Singapore Business School, SIS is releasing the findings of the latest business integrity research. The study, which uses the Transparency International framework, provides insights to evaluate the corporate disclosure levels on anti-corruption policy and strategy. This is the first year we are collaborating with NUSGEO CGIO on this project. We look forward to learning more insights from the research findings tomorrow. Please do join this session. Observations. While we are indeed pleased to see that corporate governance practices in general are improving in Singapore, there are some observations from our research into the Q&A on annual reports which companies should adopt. Firstly, be clear and direct. Companies should be forthright and state the facts and provide clear explanations, especially when addressing difficult issues and losses. In one instance, the chairman praised how well the management had done. This is in spite the company had made losses for several years. In fact, the loss was not even mentioned until you flip over 30 pages into the annual report. Companies should provide a fair and balanced report on their status and be clear and direct in their communication with shareholders. Secondly, timely disclosures of risks. SIAS is particularly disturbed by the lack of disclosure of key risks and associated risk management strategies. In our review of companies through the Q&A of their annual reports, we noted that some companies lack making timely disclosures. For instance, SIS questioned one listed company that ran a foreign worker dorm, which was designated an isolation area for non-disclosing this fact. Companies should make timely and meaningful disclosures, not just materially price-sensitive, but trade-sensitive information as well. This means that companies have to disclose information that would influence an investor in deciding whether to buy, sell, or hold securities. Thirdly, engage shareholders and stakeholders. This pandemic has also seen many companies conduct capital raising and other corporate actions to shore up their balance sheets. However, companies should continue to engage their shareholders and stakeholders to provide them with the rationale for their fundraising and to account for their use of funds. The social distancing measures in place should not be an excuse for not engaging with shareholders. In the SIA example, which was conducted during the circuit breaker period, SIAS sent questions to the company regarding their planned fundraising and rights issues. SIA responded to the SIAS questions in a timely manner, and we even recorded a dialogue with the CEO. With technology today, having engagement and taking questions live from shareholders should be part of any listed company standard operating procedure. SIAS will continue to monitor companies and review the annual reports. There are at least 12 companies we found which have given us serious concerns. The areas of concerns which we are monitoring include relationship and qualification of IDs, the level of non-audit fees, receivables and impairment of joint venture off-balance sheet counting, long-term performance of REIT manager, impairment and valuation of assets, going concern and independence of directors, attendance of chairman at board meetings, long-term performance and separation of chairman CEO, attendance of directors, clarification of IPTs, buying of company shares during M&A and prior to announcement of contract wins, corporate governance report. One company even based their corporate governance report on 2012. You can find all the Q&As on annual reports published on the SIA website. Shareholder activism on the rise. One observation is the number of activists is increasing, and their tactics and strategies are changing too. No longer can companies put on lavish meals, in the hope that shareholders will flock to the buffet instead of focusing on the company's affairs and resolutions at the meeting. There are more institutional investors and hedge funds investing in Singapore-listed companies, a testament to the growing attractiveness to the quality of companies in Singapore. However, are companies prepared for this new breed of investors? How do you engage them? Companies should take a critical look at their businesses as an activist would, looking hard for underperforming components. They should understand which activists might be interested in or attracted to the company and why. And they can better understand their shareholder base and have a tailored engagement plan. Any gap in your communication or disclosures will be met with action from these activists. If a company only thinks that shareholder activism is by hedge funds and institutional investors, they have to think twice. Today, individual shareholders are also actively seeking greater accountability from boards and senior management, testament to the growing number of EGMs called by individual shareholders, who are not afraid for a full-blown proxy contest that seeks to replace the entire board. I hope I have set out the context of the challenges and opportunities for these challenging times and for the week's sessions. Thank you, Mr. Ong, for gracing today's conference. Also, a big thank you to all our distinguished guests and speakers for their participation and all of you for your attendance. I also want to extend my deepest appreciation to our sponsors, donors, supporters, and endorsers for coming forward to support this event and SIAS. Thank you all, and I wish you all an enjoyable and enlightening week. Thank you.
And thank you, Mr. Gerald. And indeed, it should be standard operating procedure for companies to take questions during AGMs. The virtual AGMs we hosted, all the companies were very happy to just answer the questions in advance and not take any during the AGM itself. The technology is there. It seems a shame that we need to remind companies to avail themselves. And with that in mind, that gives me a chance to introduce our next speaker for his opening address, Deputy Managing Director of Financial Supervision at the Monetary Authority of Singapore, Mr. Ong Chong Tee. Welcome to the show to you as well.
Well, thank you very much, Mark. Mr. David Gerald, President, CEO of SIAS, distinguished guests, esteemed panelists, ladies and gentlemen, I'm really pleased to see so many familiar faces here, and I'm very delighted to have accepted David's kind invitation to join you to launch the 2020 Corporate Governance Digital Symposium. And I'm particularly pleased that SIAS has continued its series of Corporate Governance Week in this digital format. This year, as we know, has and continues to be a challenging one on many fronts, as governments, companies, and individuals manage the pandemic economic fallout. And SIAS Digital Symposium, built around the theme of COVID-19 and corporate governance, is, I think, most apt. And I believe this year, 2020, will also be a pivotal period for reflection and learning by revealing useful corporate governance lessons, just as 2020 vision is often colloquially used to refer to good eyesight to see things around us. Now, the fluidity of the ongoing pandemic and the economic situations have accentuated the importance of stakeholder engagement, much along the lines of what David described earlier. And it's really to manage business pressures in the short term to build resilience for the long term. And companies that engage their stakeholders proactively will foster trust and support. And this is the more important to my mind in times of economic stress and business uncertainties. It will be important for boards to monitor and assess their effectiveness in the COVID-19 operating environment. Some areas to my mind could be, for instance, the interactions of the board risk committee with other board committees. Have those been adequate? Other areas may include the quality of board discussions in virtual meeting formats, the support from boards in public and investor communications, and so on. Importantly, in periods of crisis or stress environments, boards must be able to exercise good oversight of the company's strategy and business resilience plans. And this will include the adjustment to new norms of office functioning and the relevant business and digital transformation. On the regulatory front, the MES has worked with the SGX RegCo and ACRA to ensure that our regulatory framework balances the operational challenges faced by issuers and the information needs of investors. Let me just highlight a few areas. First, on the conduct of virtual general meetings. Travel restrictions and safe distancing measures have made it difficult for in-person general meetings to take place. But even in such an environment, it is important for issuers to update shareholders on the state of the company and, when necessary, to be able to complete urgent corporate actions that require shareholders' approval expeditiously. Hence, there was a need to allow general meetings to proceed in virtual and hybrid formats. However, our company law and issuers' constitutive documents provide for personal attendance at general meetings. And therefore, in April this year, as David mentioned, the MAS, ACRA, and MINLAW worked with the SGX RegCo to fast-track legislation to provide legal certainty to listed issuers so that they may implement safe distancing measures imposed by the Ministry of Health and to hold virtual general meetings. Some shareholders may naturally be concerned that virtual meeting arrangements could limit their active participation, such as in posing questions to the board. We have put in place measures to facilitate informed and effective participation. ACRA, MES, and SGX RegCo have jointly published a checklist to guide issuers on the baseline requirements that issuers should adhere to in the conduct of these virtual general meetings. And this includes broadcasting the meetings by live webcast, supporting proxy voting, and allowing shareholders to ask questions and have these questions addressed ahead of the general meeting. And all substantial and relevant questions, as well as follow-up questions, must be addressed by the board of directors and/or management prior to or at the general meetings. This will allow shareholders to vote on an informed basis and also enhance investor confidence. Now, issuers may now continue to conduct their general meetings via alternate non-physical means up till June next year, and are encouraged to do so. This will minimize in-person interactions as safe distancing measures remain important in the foreseeable future, even as such measures are progressively and cautiously relaxed. The MES and SGX RegCo will closely monitor the experiences of issuers and investors in the conduct of virtual meetings. If these meetings can be carried out effectively, MES and SGX RegCo are open to allowing hybrid and fully virtual meeting formats to be a long-term option. What is important is that such new meeting formats should not compromise effective shareholder engagement, can allow proper verification of attendees and voters, and facilitate accurate and secure voting processes. Another area is timely and accurate disclosures, and David alluded quite a bit to this in his remarks. Stakeholder engagement is not just confined to annual general meetings. Our regulatory framework requires listed issuers to keep shareholders abreast of developments through timely and accurate corporate disclosures. It is important that shareholders have up-to-date information on material changes in issuers' business and operations to be able to make informed decisions. This is even more crucial in times of economic stress, and there were many good areas highlighted by David earlier, including the importance of non-financial information and the timeliness of information. Issuers should explain their business plans clearly, provide specific risk disclosures, and engage in regular dialogues with their investors. to facilitate investors' understanding of their business situation. On this, MAS fully supports the guidance to issuers issued by the SGX RegCo through its regulatory column in April this year. In particular, listed issuers are reminded of their continuing obligations to make timely and clear disclosure of the impact of COVID-19 on their current performance and on future plans, as well as the mitigating measures to manage emerging threats arising from the COVID-19 situation. Now, regulations alone cannot assure robust and open discussions between the listed issuers and shareholders. Our capital market works best in a regime where all shareholders play a part by highlighting inadequate or poor practices. We are therefore very heartened to have partners such as SIAS and also the Corporate Governance Advisory Committee, or CGAC, to foster good practices on meaningful disclosures and shareholder engagement. The industry-led CGAC has taken a lead to drive market best practices for transparency to shareholders. For instance, the CGAC issued a statement in September recommending that companies should disclose whether their directors intend to subscribe to their personal rights entitlement. And this would help shareholders make their decisions regarding the rights issues, especially at a time where many issuers may be considering rights issue to shore up their balance sheet. MAS supports this industry-driven approach to develop good disclosure practices beyond passive reliance against a rule book. It will engender confidence and trust and allow market discipline to drive. So let me conclude by emphasizing the critical role and responsibilities in directors' discharge of their fiduciary duties. I do not think anyone would disagree on the importance of director duties, but how to do this well can sometimes be in question. I'm told that some directors avoid any actions may be seen as taking over from management, and rightly, executive decision-making must remain the mandate of the CEO and his or her management team. But as this pandemic has shown, directors also cannot be passive bystanders. They are stewards of a company's assets and its ongoing viability, and owe a duty to shareholders, regulators, employees, clients, and even the general public, especially if the company has an important market role. While directors seek to avoid being intrusive and not having to look over the shoulders of management, looking aside is also not acceptable given the fiduciary responsibilities and accountability. A good and effective board must be able to manage that board management boundary well and to allow the executives to benefit from the directors' involvement on issues of risk and strategy on the one hand, and not to hamper the executives from doing their job on the other. Finally, as I highlighted earlier, a strong and effective corporate governance ecosystem is one where there are collective efforts from all stakeholders, including the analyst community and industry watchdog or bodies. SIAS is one excellent example of a key stakeholder in Singapore's corporate governance ecosystem, who has been promoting best practices and protecting the interests of investors for over 20 years. The partnerships between regulators and all stakeholders in the ecosystem will continue to be important in uplifting the standards of corporate governance in Singapore. And on that note, may I wish everyone a wonderful week and have a wonderful event in this symposium, and do keep safe and well. Thank you very much.
And thank you, Mr. Ong Chong Tee from the Monetary Authority of Singapore. Let's get an international perspective now with our guest joining us live from Europe, where it's just gone past breakfast time. He is Carmine Di Noia, Consul Commissioner and Deputy Chair of the OECD Corporate Governance Committee. Carmine, good to see you again. Where are you joining us from today?
You know, I'm in Rome, in my office actually. Weather is not so nice, but it's still quite warm in Italy. I would say in South Europe, situation is a bit, you know, we are a bit worried, but actually still manageable. So Thank you very much. I mean, I'm happy to be there, and so it's my pleasure today to deliver a special address to the Digital Symposium. And I have to thank David Gerald, also on behalf of the OECD and the Corporate Governance Committee, for his invitation. And this is the third in a row, so I'm lucky. And CS continues to play a key role in the growth of capital markets in Singapore, and is an active and reputable player in the international corporate governance dialogue, being also a member of the OECD Asian Roundtable on Corporate Governance, which actually this year will be also taken, from remote. But okay, we are accustomed to this. Last year, actually, I delivered the opening address to the Global Corporate Governance Conference and to the weekend. I was very happy to be there. At that time, the objective was to discuss the impact of technology on corporate governance. And I concluded that technologies would inevitably have had an impact on regulation, supervision, and enforcement of corporate governance standards in the near future. Nevertheless, it was still hard to affirm with certainty that new technologies would be able to reshape corporate governance structures and overcome corporate governance institutions within a company, eventually replacing a key actor such as the board. And I said goodbye, hoping to meet each other in person this year, and not to meet only artificially intelligent algorithm directors. Actually, today we're not attending in person, but we are attending the symposium remotely, because few months after the conference, the COVID-19 pandemic took everybody by surprise and has imposed severe constraints to human activities after, the tragedy that has been, causing, and hopefully will be, limited in the next future. As a result, companies have faced the liquidity problems and difficulties to meet their regulatory and financial obligations. Many jurisdictions have taken steps to adjust certain regulatory requirements, such as the organization, as was mentioned by David Gerald, of shareholders meetings, and the filing of audited financial reports, which are deemed particularly important at the moment for investors. International and national regulators actually try to cooperate and to accommodate, companies and investors, trying to find and to strike the right balance, which is not always easy to find. Actually, you may know, many of you, that the OECD also in May, after the meeting of the committee, we published a national corporate governance related initiatives during the COVID crisis, which is available on the website and on the very well managed page on corporate governance and corporate finance studies, including, and there is a survey of what the jurisdictions have done, including Singapore. And I have to thank Greg Metcalf, because the work that his staff is doing is amazingly important. Nevertheless, COVID-19 has created a unique opportunity for all companies to reshape their role and their organization, going beyond the financial performances and increase weight of ESG dimensions in corporate governance and asset management. And this is a key issue, has already been mentioned. Today, we're facing a challenging scenario. The point is no longer only the opportunity of internal reorganization of companies to take advantages from applying new technologies, as we discussed last year, but also the need to rethink the role of companies in the society. Such a shift requires a successful and sustainable recovery that in turn implies a strong commitment to support financially resilient and dynamic business sector. The COVID-19 crisis indeed has revealed the need to anticipate and manage unpredictable systemic threats, and the need to support the development of a resilient business sector built on adaptability, innovation, and flexibility. And I guess that the impact of COVID-19 will be carefully also analyzed in the first conference and the first panel, which will be held just after this. State aids in many countries have provided companies with emergency liquidity through credit guarantee scheme in different ways, but in the short term, they are bound to become new corporate debts. The huge increase in corporate indebtedness will require companies to rebalance their capital structure by means of material and important equity raising. The effective access to market-based finance should serve in the short term to strengthen the balance sheets of companies whose financial position have been hurt by the economic slowdown, and in the long term, to build resilience and secure capital for new investments that will contribute to new jobs and an increase in productivity and hopefully a sustainable growth. A high quality and more robust corporate governance is a way to prevent corporate misconduct, creating an environment of trust, transparency, and accountability necessary for obtaining long-term investment, financial stability, and again, sustainable growth. And I guess that the second panel will also, as also Mr. Ong Chong Tee will also deal about this very, very important topic. And an even stronger corporate governance is needed in companies where the state is, was, is, or will be the owner of the major investor as a result of state intervention to avoid companies' collapse following COVID-19 pandemic. There is the risk that the state lacks the expertise to act as an entrepreneur, which in turn may undermine the economic recovery. In the last few years, we have faced a shift from the shareholder primacy approach to a more modern standard for corporate responsibility, since the market has called on business to refocus corporate governance around a multi-stakeholder and long-term sustainability perspective. Companies willing to raise equity and/or long-term debt need to support ambitions with a well-defined internal structure of responsibilities, accounting, risk management, as was mentioned by David, and reporting. The board of directors should ensure that internal structure and practices remain updated and are effectively implemented in order to meet the company's new intention. Why the board? Because the corporate culture starts at the top. And so it's very, very important to have effective boards with, diverse and functioning effectively. Actually, the OECD corporate governance principle, our Bible, and I always have on my desk, they're very well written. They are starting to, to have some years, but actually they're very, very modern. They clearly state that, and I mentioned, and I read the sixth principle, the one on the responsibilities of the board, that the board is not only accountable to the company and its shareholders, but also has a duty to act in their best interests. Boards are expected to take due regard of and deal fairly with other stakeholder interests, including those of employees, creditors, customers, suppliers, and local communities. Observance of environmental and social standards is relevant in this context. So the role of stakeholder in corporate governance is important, is also emphasized in Principle 4. So the corporate governance framework should recognize the rights of stakeholders established by law or through mutual agreement and encourage active cooperation between corporations and stakeholders in creating wealth, jobs, and the sustainability of financially sound enterprises. Close quote. If a clear commitment to sustainability needs to be embedded in the duties of company directors and into the governance rules related to company management, supervision, and incentive structures, policymakers and boards, companies, and investors may use some tools to align board behavior to the long-term purpose of the company, and short-term and long-term should be also again, object of the conference. Maybe we should have put more emphasis in requesting companies to link part of the remuneration packages of board members, notably the executives, to sustainability goals. And maybe, this is a hot discussion, has been in Europe, in the States, and in Singapore too. Maybe tailoring the requirement to publish interim management report, maybe possibly, substituting, replacing them with, press release detailing the eventual price-sensitive information. And this could be even more frequent than company reporting. Information is essential for investors to assess, actual and potential shareholders, to assess the viability and prospects of a company. Both these tools may reduce short-term pressures on issuers and encourage sustainable value creation, giving managers and investing an incentive to adopt a longer-term vision. Recent studies show that companies performing well on sustainability factors are more competitive and resilient in the crisis period. A sustainable pay aligns executive incentives to risk management policies, pushing them to a close monitoring of non-financial performance, included in the remuneration package. However, the inclusion of non-financial criteria is not simple. because metrics for sustainable pay are often non-strategic, inconsistent, backward-looking, and not standardized. Top areas are employee health and safety, maybe injury incidents, and environment, spills and leaks, but are aimed mainly at risk mitigation and regulatory compliance. Most metrics focus only on the improvement on past performance, injuries and environmental damages. Many boards tie compensation to inclusion on third-party CSR lists or indexes, relying on third-party rating criteria and trustworthiness. In order to focus corporate governance around a multi-stakeholder and long-term sustainability perspectives, the board needs to be efficient. But what makes a board efficient? You know, various elements we have discussed extensively in these conferences, in the OECD, size, composition, and functioning. Just on one thing, and the third panel will be about it, and it was mentioned also before. With regard to composition, it's clear that diversity in general adds value to the board. But gender diversity maybe have a pivotal role in assessing board diversity. You know, to this end, some jurisdiction has enacted laws that require listed firms to have a specific percentage of women on board of directors. I'm not a fan, actually, of binding and law constraints on gender diversity, but actually it may be needed. And Italy did something like that. What is important is that this is, you know, if ever, with a transitional period, let's say start at 20% and go into 1/3, with a transitory measure, maybe expiring after some X mandates, 3, 6, 9, whatever, and applying to the whole board, not only to, you know, to executives. I'm going to conclude. A final point deals with supporting efficient, competitive, and sustainable companies. This is the key element underpinning post-COVID-19 recovery. It ensures healthier markets and investor confidence. The availability of sufficient funding in the form of equity capital will be crucial to companies, and it's necessary to put in place measures to facilitate access to market funding. The availability of information is a necessary but not sufficient condition to communicate effectively with stakeholders. And I think the fourth panel will discuss about it, and engagement is needed. To this end, actually, and the availability of information in the EU, actually, the EU Commission strongly supports measures to make companies more visible to cross-border investors, such as the creation of a EU-wide platform, a European single access point, that will provide investors with access to financial and sustainability-related company information, which reflect the needs of investors and the interest of a broader range of users. This instrument is deemed to be able to deliver the right balance between providing relevant and comparable digital information about investment opportunities to investors, at the same time minimizing the burden for companies to report this information. Furthermore, in order to maintain the cross-border investors' engagement, companies should strengthen the digitalization process, since new technologies could address information asymmetries, allowing information to be accessible to the public in a permanent and totally transparent way. We rely on your valuable inputs. Actually, I have to excuse because I will have to leave the conference, but I will be reported hopefully by David Gerald. And I expect that these issues discussed here at the symposium will feed into the OECD future work with Asia and will be shared with the wider OECD corporate governance community, where Singapore is a very active participant. For these reasons, actually, I encourage you, like it was last year, all to participate actively in the discussion and bring your best ideas to the table. I hope to be there in person next year, possibly doing the same thing I did last year, wearing a Ferrari hat after the victory the night before in the Singapore Formula One Grand Prix. Thank you very much and have a nice conference.
Thank you very much, Carmine. Good to see you again, and hopefully again in person at next year's event. Well, you heard what Carmine had to say. If you have some comments to make that we at SIAS, we here as the Singapore community can feed into the OECD guidelines, then of course we should definitely take that opportunity. The chat function, the Q&A function is available to you here on the Zoom call, and Melvin Yong and his panelists will be taking questions and your input in whatever form it comes, whether it's questions, comments, contributions, maybe disagreements with what the panelists have to say in the next 20 minutes or so. Please feel free to submit your questions at any time, so that Melvin has plenty of time to respond to them. But before we go to Melvin and his panelists, we have one more presentation to come for you. A partner and regulatory risk leader at Risk Advisory at Deloitte, Southeast Asia. Naiseng joins us here at the Corporate Governance Symposium. Hi, Naiseng.
Hi, good afternoon. Good afternoon, Mr. Kamai Denoa, Mr. Ong Chong Tee, Mr. David Gerald, Mr. J.Y. Pillay, fellow panelists and distinguished guests. I would like to start by thanking the SIAS team for inviting me to your Corporate Governance Symposium. COVID-19 has presented an unprecedented challenge to leaders around the world in both the private and public sectors and across industry segments. How leaders respond to the crisis will define them and their companies. There are three key decisions that leaders need to focus on in their response to the crisis. First, leaders need to prioritize the functional areas that will be most at risk during a crisis. Second, they need to consider the timing of their actions, when to focus on maintaining operational continuity, and when to pivot to recovery and preparing for the new normal. And third, they need to define responsibilities and accountabilities. There are specific actions that leaders can take across each of these three dimensions. I will not go into the details here. You can see that's a long list, but suffice to say that there are multiple levers that leaders can pull. Therein lies the challenge highlighted by the title of this symposium. How do we balance the different options and the short and long-term business imperatives? I believe the key is that as we transit towards a new normal in the COVID-19 world, sorry about that. I believe the key is that as we transit towards a new normal in the COVID-19 world, we need to take stock of what has worked and what needs to change. This involves making a mindset shift. The initial response to the crisis is inward focused and directed at restoring operations to the status quo. But the next stages of recover and thrive will be market-facing and will drive towards a new vision of your businesses. This also means that leaders need to be proactive and take a longer-term view during these latter stages. Whether it is in the short term or the longer term, the main objective of business leaders is to ensure that their companies have a sustainable business model so that their businesses continue to thrive. Challenging that goal are short-term uncertainties and longer-term trends. Both will ask questions of the sustainability of a business. Addressing short-term uncertainties involves enhancing operational resilience, which is what many business leaders have focused on in the past 9 months. As this slide shows, COVID-19 has created unprecedented uncertainty globally. The uncertainty is even greater than during the global financial crisis and during SARS crisis in the early 2000s. The key uncertainty is, of course, how the virus will play out, how governments will respond to the health crisis, and whether we'll find a vaccine or cure. Tied to that is how the economy will be impacted by the pandemic. The widespread disruption to economic activity has certainly taken a toll on global growth, with the World Bank forecasting a 5.2% contraction in world GDP this year. Will there be a sharp recovery next year, or will we continue to be mired in the economic doldrums? How will the distribution of jobs and incomes be affected by the crisis? COVID-19 has also exposed social fault lines across the world. In some countries, the pandemic and government's responses have become deeply politicized. As some countries start returning to lockdowns to fend off the second wave of infections, we are seeing some popular dissent and resistance. Lastly, the degree of collaboration amongst countries is also unclear. While scientists are sharing information on the virus and possible vaccines and cures, countries are rapidly signing up with pharmaceutical companies to secure their own stock of vaccines and therapeutics. There are also other uncertainties, like the ongoing trade war between the US and China, and other geopolitical flare-ups, like that between Armenia and Azerbaijan, and between China and India. Against the backdrop of these multiple uncertainties, business leaders have taken various measures to strengthen operational resilience. I will not go through all of them here, but just highlight a few that have been undertaken by Deloitte clients globally. Very often, leaders will set up a command center to coordinate decision-making, crisis response, and align communications. Many companies also introduced remote working arrangements and split teams in response to government directives to break the cycle of infection. A financial services client in China conducted training for its staff so that they will be familiar with the tools and solutions that are available. We also saw some companies engaging their lenders actively to negotiate waivers and avoid triggering loan covenants so as to maintain continued access to funding. Companies also reviewed their supply chains to identify vulnerabilities and develop contingency plans. One example was a US consumer retail giant which began sourcing a popular consumer staple from multiple suppliers instead of relying on a single supplier. We've also seen companies enhancing their communications and digital capabilities. A Chinese financial firm developed a crisis communication plan for closer engagement with its customers. A US state government has employed cognitive risk sensing to help detect potential hotspots, including virus transmission and possible reputational risk issues. While these and other measures to boost operational resilience were implemented during the early stages of the crisis, they continue to be relevant as the ongoing uncertainties could flare up anytime and trigger new disruptions. Therefore, it's imperative that companies continue to fine-tune their measures for operational resilience and test their contingency plans to make sure they are robust. While dealing with the short-term uncertainties can be all-consuming, business leaders also need to consider how longer-term trends are changing the business landscape and if their businesses need to undergo transformation too. There are several key trends that are taking place right now. First, certainly accelerated digitalization. There's been rapid adoption of digital technologies by companies and consumers. Increased virtualization of the workforce with more people working from home. There's also a growing preference for remote channels in order to avoid touch and feel and possible transmission of disease. There's also an increased focus on health and safety among the workforce, among consumers. There's a sense also that there should be greater corporate social responsibility. Witness how the banks, instead of being the bogeyman like the case in the GFC, they're now doing their part to support the economy. There's also the emergence of pop-up ecosystems. Witness Razer, witness GM, now manufacturing masks and respirators instead of their traditional products. And of course, increased surveillance. Many people accepting increased surveillance by the governments, including, for instance, the Trace Together app in Singapore. Just as certain trends are accelerating, there are trends that are slowing down. One possible trend is that of the sharing economy or the gig economy. The increase or the risk of transmission by sharing products like ride sharing or product or various tools, and that such sharing economy may become less prevalent going forward. There's also a possible slowdown in urbanization, with many people living in cities now considering whether they should move to the suburbs or even further afield to avoid a very tight and cramped surroundings that may be facilitating of disease transmission. Certainly, there will be less global movement of people, partly due to travel restrictions. And even when travel restrictions are lifted, there may be concerns about being stuck if borders are ever closed again because of a spike in cases. Certainly, there has also been reduced globalization of supply chains. Some banks that we have spoken with are now exploring re-onshoring some of their operations, having been caught out earlier due to disruptions in, say, for instance, the Philippines or India, when their call centers were suddenly found to be not working because of lockdowns in those countries. One way to think about all these different trends and uncertainties is to use scenarios, building them up to look at the different sources of uncertainties and longer-term trends. One example shown here, 4 scenarios developed by Deloitte, called the Passing Storm, Lone Wolves, Good Company, and Sunrise in the East. The focus should not be on the scenarios per se, but on how they help a company think through the different possibilities that may occur in different on different dimensions. Another way to do so would be to look at possible archetypes. That is, how a company should be positioned vis-a-vis the competition and against other possible outcomes in the market. So again, here we have 4 archetypes: weather the storm, shape the market, ensure survival, and seize the opportunity. Depending on the level of disruption caused by the crisis to the industry, as well as the resilience of the company to such disruption in the industry. While scenarios and archetypes are hypothetical and actual outcomes can be vastly different, I believe most business leaders will hold one thing true: trust remains of utmost importance in business, crisis or not. Therefore, it is very important for companies to continue to build trust with their stakeholders. And on that note, I think the first point would certainly be paying close attention to technology and cyber risks. Certainly, with greater deployment of technology in many companies due to rapid digitalization and use of online channels, there's an increased attack surface that's available to cyber criminals. As a result, you could see an influx of cyber criminals. Research done by the Interpol showed a rapid jump in the number of cyber attacks during the COVID-19 period. There are also potential delays in detecting attacks due to work from home arrangements. Similarly, working from home means that certain servers and systems could well be exposed to physical security attacks. While companies think about deploying new solutions and new systems, they also need to consider how these systems and solutions integrate with their existing systems and do not pose a weak link in terms of opportunity for attacks by cyber criminals. They also need to develop contingency plans for these new systems and solutions. Imagine these new systems and solutions were the contingency plans for moving away from physical service, physical channels. But in themselves, they also need to, there also need to be contingency plans for these new channels that are being developed. A second area for building trust is certainly in data privacy, as well as AI and model risk. As companies and customers move towards more remote channels, there's also greater tapping and use of data and data analytics. It is therefore important to protect the information that companies collect. And not only that, companies need to make sure that there's proper governance on the use of any AI and models that are used to churn or mine the data that's being collected in order to avoid any unintended bias or other unintended outcomes. The ultimate test must be that the use of these new technologies must be in the interest of customers, and there must be proper accountability and explainability to customers. In this regard, you could see that authorities are starting to take an interest in this area. For instance, MES has issued the FEED principles and working closely with industry on the Veritas framework to do various proof of concepts on how to better improve, to improve the explainability of AI and better manage model risk. In New Zealand, the government has actually worked with the private sector to issue an algorithm charter that applies equally to public agencies as well as private companies. And finally, a topic that is very close to the hearts of many speakers earlier, both Mr. Gerald and Mr. Ong and also Mr. Denoyer have mentioned how disclosures is very important in helping to build trust with stakeholders. In this regard, the SGX has provided very useful guidance on the various areas of disclosure. The disclosure helps avoid surprises and builds trust, which then allows companies to focus on longer-term sustainability of their businesses instead of short-term fluctuations. And with that, I end my presentation. I'm looking forward to the panel discussion with the panel. Thank you.
We are too. Thank you very much. And joining you on the panel, Wong Nai Seng from Deloitte Southeast Asia, Chu Sutat, Senior Managing Director and Head of Global Sales and origination at the Singapore Exchange. The Chief Financial Officer of DBS Group, Ms. Chung Sok Hui, joins us as well. Welcome to the show, along with Greg Medcraft, Director for Financial and Enterprise Affairs at the OECD. And rounding out, joining us from Sydney is Prue Bennett, Partner at Brunswick Group. Your moderator for the session is the Country Head of CPA Australia and CIAS Committee member, Melvin Yong. Over to you, Melvin.
Hey, Mark, thank you very much. Good afternoon, everyone. Thank you so much for staying with us through this entire session. Of course, you've heard from 4 various team speakers already, and you're going to hear from 4 more in the course of this hour or so in this panel discussion. So I just want to welcome everyone, as Mark has already done, introduce all the panelists. So just get this preamble for the session going. As you know, many listed companies today have had to grapple with COVID-19. It has created a very unique and profound sets of challenges for all companies. And as you know, boards of directors are charged with overseeing the short-term as well as the longer-term health of companies and their business prospects. So navigating the COVID-19 crisis requires very careful consideration of a range of issues under these unprecedented circumstances. Today, as Mark has already introduced, I'm very pleased to welcome a very distinguished panel of experts. They will share their insights on this salient topic, balancing short and long-term business pressures. And the panelists will exchange their views over this 1-hour session or so. But we also hope that you, the participants from wherever you're tuning in, that you will get involved as well, because you can also ask your burning questions to the panel. There is a Q&A window at the lower right-hand corner of your screen. If you fire that up, you'll be able to type some of your questions in, and I'll facilitate those questions as much as possible in the time that we have. So please type them in as soon as you have those questions. All right, so let's begin the discussion proper with my esteemed panel. Welcome to all of you again. Now, Nice Thing from Deloitte has nicely set the stage for our chat. And as you know, COVID-19 has redefined many business models and traditional ways of doing things. In your view, panel, have the short-term and longer-term pressures changed at all for businesses? Maybe we'll start by going around and get a point of view. We'll start with Sok Hui first. You know, ladies go first, so I'll just pick Sok Hui and then we'll go to Prue after that.
Thank you very much, Melvin. So can everyone hear me?
Indeed, we can.
So thank you. Thank you for the sort of very comprehensive presentation by Nice Thing. And I just maybe have a few points to add. So for sort of some of our industries which are more challenged, that would be like the aviation industry, construction sectors, tourism. I think there are more short-term issues that they have to grapple with. And of course, sort of some of the rebalancing of the capital structure and sort of how to deal with sort of the managing the staff numbers would be things that some of the more stressed industries will be grappling with. For banking, I think we are less affected to some extent, but we are severely impacted by the low interest rate environment. So I think what you see as net interest margin would be a big challenge for us to manage. As well, I think the demands from our customers as they sort of adapt to more digital behaviors, as well as from our employees who are working from home. And Nice Thing has mentioned some challenges that all of us have to manage too, like heightened cybersecurity attacks. Those are all on the rise, and we have to make sure that we guard these well. The other point I would add is that for banking, we'll continue to see sort of some stress translating into higher credit costs, which you have to manage too in the short term. In the longer term, I think the COVID situation has posed some we have reached an inflection point. And some of the longer terms that Nice Thing has highlighted, I agree with them, and I probably will add a couple more. So I think he has highlighted this digital consumption demand, right? So we have definitely seen it in all our sort of business lines. So the demand for online services, digital offerings, wealth products, online sort of trading, sort of corporate pay now account, you'll be surprised. We've seen 6 times increase, for example. So all these are sort of the trends that I think will continue to persist. We see sort of longer term, employees will be able to sort of have more flexibility to work from home. I think as well, managing to cybersecurity, which we have talked about, and maybe mentioning a few more like the shift in supply chains. I think you will see that this is a trend that has started. It will get accelerated. And we are seeing more nearshoring and sort of onshoring opportunities in strategic sectors like food supply, medical and healthcare. I think those would take priority. I will also just mention that there should be some significant consolidation on the back of COVID. So as companies sort of take on and they need more equity in their structures, I think we will see consolidation of companies in the longer term. And the other trend that I would highlight is that you will see industry boundaries that are collapsing. And that's something we all have to manage too, as banks sort of work with ecosystem partners. And the likes of Grab and sort of telecommunication companies sort of also participating in the financial services space. And finally, ESG is always a big topic for everyone. So maybe let me just pause here.
Indeed, Sok Hui, thank you very much. I know you've painted the whole landscape across the entire ecosystem, how the banks are plugged into all that. I'm sure you experienced that with your customers and also other stakeholders that you manage. Okay, just hold that thought because we're probably going to unpack a number of these issues and trends in the course of this discussion. Let me just go to Prue for a second. I mean, you know, we've got all the short-term and longer-term challenges for any companies. How do you see them as changing from your point of view?
Yeah, well, I've been talking to a number of investors globally about their thoughts on the impact of COVID on their investee companies, and it's raised quite a few interesting issues. One is, or obviously, how the board operates remotely because they're not meeting face to face, and it's quite different having a conversation on Zoom, for example, than that face to face. And particularly when you have board meetings that go for a day, to do Zoom meetings that go for 6 and 7 hours, and I have been involved in some, is actually quite tiring and not as effective. So I think there's a challenge there for boards. Another issue that's come up is overboarding of directors, because where boards might have met 4 times a year or 6 times, in Australia boards generally meet between 10 and 12 times, they've suddenly had to go to weekly board meetings. You think of a company like, you know, Qantas or companies in the aviation industry, they were having, and probably still are having, weekly board meetings. So if you're on 4 or 5 boards having weekly board meetings as an independent non-executive director, the chances are that you are stretched. And this is a time in crisis where investors really need that thinking of the independent director and that contribution of the independent director. The other issue is all around communication. I think communication and how companies communicate with not just investors, but also other stakeholders. But probably the most important link there is to employees with working remotely. And another issue that has come up, highlighted with COVID, is mental health and the mental health of employees who are working at home. And you've got to have that trust built in there between the corporate and their employees. And some companies have been doing that well for quite a long period of time. And because human capital is a huge component of the value of a listed company, and it's an asset that needs to be managed just as any other physical asset. So for those companies that already have that good communication and built the trust with employees, it's going to be a lot easier managing this remote working. But for those who haven't, it's probably going to get more and more difficult as the novelty wears off from working from home. So there's sort of some of the key issues that have come up when I've been talking to investors about this, and real challenges for boards going forward.
Well, that's interesting point of view from boards, Prue. Thank you very much indeed for that. Let me come back to the management perspective. Sutat, this is a point where I bring you in. So you obviously look at it from the senior management point of view, but I'm sure in your role, you deal a lot with your external investors as well. So, I mean, how are things changing in terms of how they're talking to you about the short-term and longer-term challenges?
Oh, thanks, Melvin. And I think first to qualify, although I'm management, I'm on very shaky ground here, as Sok Hui is clearly not only our board member, but she chairs our risk management committee. So I will give a perspective that is perhaps more broad in relation to the conversations we've been having with listed companies, as well as with many of the investors of all shapes and sizes. You know, I think the framework that Naising presented earlier was a very good one. And he talked about respond, recover, and thrive. The short term, when COVID first hit, a lot of focus, quite frankly, was how to survive. How do we deal with the pandemic? How do we get cash flow? And have enabled our staff to be working from home, Prue makes a good point, which is now there are mental health issues associated, but survival was first and foremost. Assuming you manage to survive, the next really is resilience. And that's part of recovery, adjusting your supply chains, making sure that you've got the right management frameworks, crisis management plans, business connectivity, continuity, and the operational resilience is critical. Once you're past that, and I think that's where it becomes very interesting about the short and the long term, is really the focus to thrive. And a lot of boards have been asking, I think, very good questions, which is, how do you ensure that you never let a good crisis go to waste? And I think that's a very important question to ask, which is, are there opportunities enabled with innovations to turn this crisis into long-term strategy? What has been digital enabled allowed for a company to be able to work with its staff, empower its staff more flexibly, and be able to get more productivity? Has that presented some unique challenges and opportunities that can be leveraged upon, strategic acquisitions, and it could even be more basic things like what's the future of work? So critical agility becomes, I think, a little bit more of a core competence in this environment. One of the big discussions that have taken place, and I think increasingly is more important, is perhaps there may be an opportunity and a need to change how the definitions of what stakeholder value is and how it's created. The pandemic has thrown a lot of good conversations, both for the corporates, looking at their workforce, and also investors thinking about sustainability and the ESG agenda. If companies recognize that their purpose and role in society is beyond just short-term profit per se, then the move towards greater ESG awareness could be a bridge between the short-term and the long-term interests of investors. Corporates need to meet the expectations in the short term, otherwise there's no long-term. I think that's fairly basic. But if the expectations are better balanced, communicated, and aligned with shareholders, then I think together collectively, we can move towards a more sustainable beat.
Okay, I'm glad a few of you brought up the sustainability issue, also ESG. I think no fewer than 2 or 3 of you have talked about that. We'll come and unpack that issue in a second, but let me just bring Greg into the picture. You haven't spoken at all, so we'd like to hear a little bit of your thoughts on that first issue that we were talking about. In your view, have the short-term and longer-term challenges changed as a result of COVID?
Okay, thank you, Melvin. Look, I think the key thing today is that the 2 key words are agility and scenario planning. That says it all, I think. You know, what this crisis, I think, has underlined, even like the last crisis, is the potential for tail risk. And, you know, that is, you know, low probability, but high consequence events, because for years we were talking about potentially a pandemic, but it seemed to be lowering. But, you know, they can actually occur. Obviously, they're tail risk, but they can crystallize very quickly and unexpectedly. So I think what we can expect going forward is that perhaps has been talked about, we will get this acceleration of pre-existing trends where I think you're going to have you've got this convergence between the short-term and long-term pressures, and, you know, the decisions and actions that businesses take today, you know, to build sustainable value and deliver long-term returns. It's all changed. So I think, again, thinking about tail risk, how you manage them, how you think about different scenarios is really important. I think, as has been talked about, you know, the growth of global value chains and their potential for disruption, obviously it's been highlighted, it's crystallized more. We've got the growing geopolitical tension has shaken markets over recent years, again, thinking about scenarios. You know, the physical effects of climate change, more frequent extreme, you know, events, you know, how quickly is that transition going to have to happen? You know, I think now you've got to start thinking a little more clearly about it. And also, most importantly, I think what a massive change that I've seen over the last decade is, as some people have mentioned, there's the expectations from the public, the power of the crowd. And I saw this when I was the chairman of the Australian Securities Commission. The crowd is becoming more powerful than government or stock exchanges to actually say, well, we don't think that is acceptable. And I think that's the one, if you want, that has the power to really amplify accountability and also effect on companies. So if you fall short of that, no matter whether you're complying with law or not, you will be impacted, and you may lose your customers, you may lose your employees. So I think the world has changed, and I do think it does come back to this issue as discussed earlier about robust risk management, and that does incorporate non-financial risks and scenario planning and agility. So it was interesting, the earlier comment about how often companies are disclosing their risks and also their tolerance and how to deal with it. And I think the successful companies of the future are going to have to learn the lessons from this pandemic, that sustainability and resilience actually do count. And if you ignore them, you will suffer the consequences, not just in your equity holders, your customers, or potentially employees. So I do think you've got to start to incorporate these things into your long-term decisions, because the long and the short are coming together.
Yep, and the lines are blurring as well. Thanks very much, indeed, for Greg.
Absolutely.
So, I guess we want to go back to that whole issue about sustainability as well as competitiveness, because as you know, in this COVID era, boards and management now grapple with a whole range of issues. And I think many of the panelists have talked about them, whether it is about mental health, health and safety of employees, customers, supply chain disruptions, and even perhaps, touch wood, potentially more lockdowns if there are fresh waves of the virus going on. So in all of these, given all of these difficulties, panelists, how do you think companies can perhaps remain more sustainable, can perhaps institute more policies that will make them sustainable and competitive over the longer term? Maybe we'll bring Nising in. You painted a whole picture for everyone. How do you see things in terms of companies extending that whole sustainability and competitiveness question?
Yeah, that's a very challenging question because I think at the moment, in terms of disclosures, public disclosures on sustainability issues, there has not yet been sort of alignment of the approach to disclosure, which makes it then very difficult for investors, for stakeholders to compare across companies and make an assessment whether or not one company is more risky than another in terms of sustainability risk, and then price that into the value of the company. I think going forward, if more could be done in terms of putting this common approach to disclosure, I think that would be one. And I think there are efforts currently being undertaken by the WEF together with the Big Four accounting firms to precisely go about doing this. The second issue related to that is really the dearth of environment or ESG data that's out there. Again, that's partly to do with disclosures by companies, but also partly public sources of such data can be made more readily available so that analysts can look at that information and actually draw linkages between environment risk and actual performance of companies, so that investors can actually draw that link and price that into securities as well, and actually consider that in their investment decisions, so that a longer term consideration actually gets factored into the day-to-day fluctuations in equity prices.
All right, Prue, how do you see things? How do you think companies can remain sustainable, competitive over the long term, given the kinds of issues that they need to grapple with today? Prue, you're on mute, so if you unmute yourself, we'll hear you.
Sorry. Just before I go into the question, there's actually been quite of a watershed situation in Australia, and it may not be COVID related, but it was Rio Tinto and what has happened with their senior leadership team. And here you had a strongly performing CEO. Share price was up 40% in the last 6 months, yet shareholders said no to the actions because they were not acceptable by society. And so I think, taking on from what Greg was saying, there has been this shift of what the crowd thinks and what society thinks of the company. And it's really incumbent upon boards to understand, and senior leadership teams, what the impact of the company is in generating their returns. And all companies have externalities, some positive and some negative. And they really need to understand where those negative externalities are and make sure that they minimize those negative externalities and be transparent about it. And I look at sustainability, or I define sustainability as how a company makes its money, not how it spends its money. Because a lot of companies see sustainability and ESG as philanthropic. So we've donated X million dollars to charities. It's how you generate your returns. And I think also boards need to be cognizant of the Sustainable Development Goals. They should inform strategy. And at the end of the day, sit back and ask themselves, each board member should ask themselves the question, has the operations of the company over which I have oversight and I'm a steward had a negative impact on any of the SDGs? And if the answer is yes, they need to revisit strategy and amend it. So I'm not saying that it's a corporation's responsibility to go out and solve poverty or create fresh water for everybody, but they should not be having any negative, the operations of that business should not be having a negative impact. And where they do, there will be loss of value for investors. They won't get investor support. There'll be impacts on cost of capital. So it's really important for boards to understand what sustainability is and what investor and other stakeholders' expectations are, and be transparent.
Okay, let me bring Sok Hui into the picture. I mean, you sit on boards, but you're also in management as well, and you probably look at the whole ESG component in your day job as well. So how do you see things in terms of that whole sustainability question?
So we're at the forefront of sustainability reporting. In fact, 2 years in a row, we produce sort of our own standalone sustainability report in addition to the annual report. So for banking, I guess the biggest impact is really financing, and we are taking care to make sure we don't finance, or we no longer finance sort of, we don't do some of these loans to some of the coal mining sort of companies, and we are focused more on the renewables, right? Financing of renewables. And then of course, even in our own sort of buildings, we make sure we are green and we do sort of what we can for society. So all the OECD goals, I mean, we do a lot of that. But maybe what I want to also focus on, in addition to sort of the environmental aspects of the ESG goals, is also the sustainability of businesses, which I think is also important as we think about the competitive positions of organizations looking out post-COVID. And here I think the reason why a company exists and what you can do for your customers, the real things you do for real people counts for a lot. So I would say that that is an important aspect of any company. So for example, in banking, everybody needs to save, everybody needs to invest, to take up a loan, to buy sort of for their business or for their sort of buy a house. And therefore we have to sort of, our philosophy is really about how do we make it convenient for our customers and sort of look at it from the customer's perspective. And we are serving it at their convenience, in their domain, in their time. In fact, we always said it's a good thing if we become an invisible bank. That means wherever, whatever you want to do and you have a financing need, you actually can do it with your mobile phone, you know, and that's really the beauty of where we think services can be delivered more and more through digital means. And the COVID gave us a great opportunity to accelerate a lot of these thinking.
Yeah, I can see that that thinking has very much become part and parcel of what DBS has been doing in the market. Thanks for that. Greg, come on in. Your view on that whole ESG sustainability equation.
Well, yeah, look, thank you. I'd probably mention two things. First is, it clearly has been mentioned, the trust in business. If you don't have trust, you actually don't have a business. So everyone knows that empirical research has actually shown that a business's capacity to generate trust and loyalty in its workforce, its customers, and society is a predictor of strong returns on equity and return on assets. So, but again, a little bit what Prue was saying, more and more it comes down to that social license to operate, the expectations from customers, employees, and others on business behavior. And, you know, if you don't, and it's dynamic, it keeps moving. So, you know, that if you want, the front page test can change in terms of what is right or not. And it was mentioned about the case of Rio in Australia. It was legal, but it wasn't acceptable. So you've got to watch that, because that is really, I think, going to impact long-term value more and more. So I do think, secondly, that the growing use of ESG risk management practices, you know, they are becoming widespread. It's a very useful tool to manage material sustainability risks, and that will impact on competitiveness in the long term. You've mentioned issues like supply chain and employee safety, and, you know, but the measurement and the management of ESG risk, you know, can have an important risk, you know, be good part of a risk management framework. But the analysis that we've just released in the last week in our banking and finance outlook is actually showing that measuring and benchmarking this performance is costly. There's no standard metrics, weak comparability between companies. There's difficulties in verifying the underlying data. So the problem we have today is, ESG is a very good risk management framework, but really the lack of comparable data, as was mentioned a bit earlier, is a major problem. We've now, I think, got 31 trillion referenced on ESG. So it is a big problem, and companies are looking to enhance risk management, especially after COVID-19. And so what we've done at the OECD is embark on an ambitious project to really look to make ESG practices in financial markets more fit for purpose. One of the things we've called for in our report is a global taxonomy of ESG data, at least a minimum. One of the best things I've seen, and maybe SGX can comment on that, is as a starting point, is the NASDAQ's ESG guidance disclosure, which is 30 data points. To me, that is a pretty good start for when you start thinking about comparing companies, and it is an issue. And just to point on the global supply chains issue, we are seeing more and more companies taking on the OECD responsible business conduct guidelines, which apply about not just the minimum, but go beyond the minimum to a little bit what Prue was saying. That we are seeing this becoming more and more appropriate, and it does apply in finance and investment. We have a set of due diligence. So I think this whole ESG area is just going to grow, but what we've got to make sure that it's not one of the cases where, in the land of the blind, the one-eyed person is king, that the data, you're not in a vacuum here. At the moment, it is completely fragmented and it is completely a mess.
Okay, I got a few people nodding on Greg's very interesting point. Then anybody wants to jump in with a point of view?
I sit on the board of the International Integrated Reporting Council, and was in a meeting in New York last year, and there are over 200 organisations that are trying to solve this problem. There is some consolidation going on at the moment, but I sympathise with both investors and corporates because of the confusion that's out there. And I think the global community needs to come together to solve this problem and try to get onto an umbrella similar to the way that the accounting standards operate globally.
Yep. Now, I do appreciate that we've been talking about ESG, but there are other areas within the whole corporate governance space, of course, that boards will have to deal with. Of course, effective governance as a whole, and also controls that are all in place at this point. But given the new normal that we're seeing, or at least heading into the new normal from now till after the COVID era, whenever that is, folks, with more things like remote management, working from home, remote working from anywhere, call it whatever you might, there's also limited presence on the ground by most companies, especially management, and also by boards, I suppose. How do you think that they can ensure better, more effective governance and controls in this period that we're heading towards? Call it a new normal for all intents and purposes at this point. Suthat, do you want to come in first?
Yeah, thanks, Melvin. Well, the new normal that we are in right now perhaps will go on for a considerable period of time. Hopefully, boards as well as management are increasingly digital enabled, and they adopt not just the technology, but really the best practices of corporate governance will actually find their way in this environment. So, quite frankly, senior management of companies have a critical part in dealing with the challenges at the front line, but board of directors also play a very important role in steering companies through this pandemic and other future crises that may occur from time to time. I do think that the role of the board as a resource shouldn't be just a control or oversight mechanism, but it can add value with the right level of engagement with management. But that would mean that there's got to be a good thorough review of the arrangements around information flow and decision making. In the world that we had been in previously, there were already emails. You don't always need to be physically present to have a meeting, but being able to ensure that you have the right information, the right data. We had a conversation just a moment ago about the plethora of ESG type metrics and the lack of common standards. But being able to think about what would be the right type of information at what level of frequency on a timely basis will actually help board members be virtually proximity to their business and the style of governance and level of engagement much closer. So, I think there are opportunities to be able to be nimble, to be ready to convene, to decide on matters, rather than 4 quarterly meetings or 6 sort of meetings every year. The right information flow, the right level can actually be very helpful in this process. The teams that could be put in place ad hoc for boards to help support management that may be called for each and every crisis can also vary, but it really comes down to, do you have the right level of data? Do you have the consistency of information flow? And frankly, if we are all accustomed to meeting like this, then it's a lot easier to deal with as and when.
Well, there is a joke going around that you may not need to travel very much for business anymore after this whole thing ends. But anyway, so we come into the picture. I mean, you see it from both sides, right? From a senior management point of view, also as a director's point of view, this whole idea about effective governance and controls as we head towards this eventual post-COVID era. How do you see this as evolving?
So I think the board plays an important role to help guide the strategy of a company. And what we found was that our ExCo, the board ExCo, a smaller committee of the board, meets more regularly. And that has been actually a good forum where we can share with the board. So it's a subcommittee. You don't have to involve the whole board. It meets more regularly. And during the COVID period, what we do is we actually update the board very regularly on the situation on the ground, what's happening to sort of our liquidity lines. So in the earlier periods, what are we seeing from customers? Are they taking up moratorium sort of loans that the MES has put in place, et cetera, et cetera. So it's an opportunity sort of to keep the board abreast. How many employees are affected? How many working from home? Constant dialogue, right? So the board is able to get a good picture, to challenge management, to see whether it's all within kind of, because the board sets values, culture, risk appetite, whether it's in line with the entire way they think the company should be managed. And then sort of coming off that, I think the board begins to sort of look at longer term sort of COVID matters. What strategy will drive the bank going forward? How will the bank be transformed going forward? And here we have very interesting options that we consider, we place before the board. These are new ways that we think we can find opportunities to enhance returns in a very low interest rate environment. These are the things that we'll do. Longer term ideas about how we can have more employees working from home. What's their appetite for that? Longer term ideas about how to convert physical branches to more digital branches. What does the board think of that? So I think it's this constant dialogue to get the board's appetite and their guidance and their thinking that I find to be very valuable.
Okay, Prue, come on in. Do you agree with that thinking? Is that how you see boards and management?
Sorry, Melvin, if I could just add.
Sure, Sudha, go ahead.
The comments. I think what she raised is very important to the extent that we have benefited from her attention as a board member to our company during this period as well. So lots of information to Sok Hui and also lots of guidance and support throughout.
Indeed,
Okay,
thank you. Yep, great comment there. Yeah, Prue, come on in. I mean, we've been talking about this whole effective governance and controls for that new era. Obviously, Sok Hui and Sutat, they were both speaking partly from a board perspective, but senior management, but you deal with directors a lot. So what do you think?
I think the other thing to underpin that framework are principles and values. And they really need to be defined by the board and the senior leadership team and communicated throughout the organisation. And do they need to be revisited because of the working from home? Probably not. Do they need to be reinforced with the new working environment? The answer to that is probably yes. We saw with Wells Fargo, 5,000 people didn't know the difference between right and wrong when they created new accounts. So this whole idea of principles and values is extremely important. And particularly when people don't have that face-to-face meetings and gatherings. And as I said before, that communication, that internal communication has now taken on a whole new meaning, and it needs to be done differently. And that needs to be recognised by the senior leadership team, but incorporated in that internal communication is that reinforcing of the firm's principles and values. And I'm always researching companies, and it does surprise me the number of companies that don't have defined principles and values.
Okay, one group that has a lot of principles in terms of corporate governance is OECD. Greg, come on in terms of, how you see this whole transition towards effective governance and controls as we welcome that new era that we're expecting.
So first of all, as Prue probably knows, I'm actually a big believer in culture, and actually to me, culture beats strategy any day. So I totally agree with what you said about values, because we had obviously in Australia we had some extraordinarily poor culture inside of our banking system, and it flowed down. So I think that is critical. That's the starting point, right? I think the other thing though for boards and the new normal, I think we talked about ESG risk management and adapting to challenges. I think there are probably three things a board can do thinking about risk management. I think first of all, they should tailor their risk management to its sustainability circumstances and specific ESG risks for them. I think they've got to think about their board structure, their composition procedures, so that they can deal with ESG risks, including using risk committees if appropriate. And, we are seeing the evolution of dedicated ESG and sustainability committees to think about more broadly the whole issue of sustainability. I think secondly, really important is actually you've got to develop board capacity and understanding of ESG risks and the standards and frameworks and metrics and tools, and including perhaps interaction with management and subject matter experts in and outside the company, because there's no use if you can't actually understand what you're talking about, right? And then thirdly, clearly, is establishing reporting disclosure frameworks in line with best practice. They can be voluntary standards, like I mentioned, perhaps the NASDAQ one, or there's probably SGX has got a similar one, or the EU's just brought out their non-financial reporting directives. There's no reason why companies can't adopt that, but there needs to be, you need to have what we need is a consistent standard, but it doesn't mean to say you shouldn't do something now that's trying to be consistent. And again, you need to basically explain the rationale for how you've chosen which ESG risks that you are focused on beyond perhaps the minimum disclosure. But as I said, it is an area where in fact there's a lot to do. And I do think the ESG model is a good one to think about for companies going forward, because it does include things like supply chain resilience and continuity, etc.
Okay, I'm going to welcome a comment from Nising in a second, but meantime, I'm just going to send out my usual alert to everyone that if you've got questions for our panelists, please feel free to type them into the Q&A window. I do see one coming for Sok Hui already that we will address in a moment, but first, let's get to Nising. Just continuing on that whole discussion around effective governance and controls. What's your take on this?
Yeah, I totally agree with Greg and also Prue on the importance of culture, values, principles. Reminds me of a vendor demo a couple of weeks ago. They were showcasing this tool that actually tracks keystrokes of the employees, how long employees have been online, whether they are surfing to non-approved websites or e-commerce websites rather than doing their work. And I was just thinking to myself, why would any employee, knowing that such a tool is being deployed in the company, actually want to join this company, right? And it's not that because they may want to have a break every now and then, but it's more from a culture perspective. Do you trust your people, right? And do you trust them enough, right, that they will demonstrate the right values and get their work done, right, within the time that they have? And I think particularly in this climate where people are working from home, etc., what the board can do is really drive the agenda to get these cultural initiatives really part and parcel of the corporate agenda. And it involves providing the resources to management to do, whether it's workshops, to educate the employees on what are the right behaviors, what are the wrong behaviors. One thing that we found that could be extremely useful and impactful, it's not just the tone from the top, but also the tone at the middle, because employees typically look up to their seniors, their immediate supervisors for the role model. So actually addressing subcultures at that level of individual teams will be extremely important. So some of these ideas that Greg and Prue shared earlier in terms of focusing on culture and values and principles is extremely important for any company.
Yeah. Great, thanks, Nising. Anyone else wants to jump in with a point of view on this whole idea about culture? No, if not, I'll take a question coming from Don Sevier, who's typed into the Q&A window. Sok Hui, you might be able to see this as a bit of a longish question, but I'll try and read it for the benefit of the attendees who might not be following the Q&A window. But this question is for Sok Hui. So for the banking sector, particularly in the Philippines, I suppose Don is from the Philippines, most banks are literally banking on the SMEs. They're focusing on this particular stakeholder group to provide growth in the coming years. But SMEs, of course, have been very hard hit by the pandemic. So together with fintech disruption, this has been somewhat of a double whammy, I suppose, for banks in the Philippines and elsewhere as well. Any thoughts from you, Sok Hui, on where banking should be going from here? What boards can do to support perhaps the growth of banks?
So I guess in this COVID environment, I think we, as banks, I think we have a fiduciary duty to figure out, for a lot of our companies, which ones would be able to make it through the crisis and how we can be as supportive as possible. So I think we are quite fortunate in the Singapore situation where the government has actually guaranteed, in a way, certain facilities. They have got moratoriums so that it actually helps the money flow into the SME sector. So that's really a huge positive for the SMEs to be able to sort of weather this crisis well. I think for banks to be able to sort of help to pick the ones that would be the winners in the long term and continue to be supportive is really a credit call for most institutions. And I think there are no easy answers to seeing how sort of some of the challenges faced by SMEs. The reality is that some of the business models might not survive COVID. So if it's a business model that will not survive COVID, then I think it's very challenging, I think, for banks to continue to extend credit to those SMEs. So I think where banks can actually add a value is helping customers maybe revisit their business models to see how it can be sustainable in the longer term, because that's really about survival in the longer term. I'm not sure if it answers your question.
Well, there is one perspective that was given, of course. Sok Hui, thank you very much indeed for that. Don, if that didn't really answer your question, feel free to type another one in. I saw another one coming from Shirley, I think it was. I tried to clarify what you meant. Maybe you might want to clarify your question and then we'll try and take that on board. But meantime, I do have another question for our panel. So we were talking about fintech. So that was a reference to fintech that Don had made in that conversation there. So as you know, fintech is one of the great disruptors of our modern times in terms of where finance is coming along. But at the same time, I think for those in Singapore and perhaps those in Australia, you might have seen this comic a few months ago where the question was, who was most responsible for digital transformation and digital adoption? Was it the CEO? Was it the CTO? Or was it COVID-19? And I think it was quite clear that the comic was quite right. It was COVID-19 that had forced everyone to accelerate digitalization. So I guess for the panel, with the traditional businesses getting into this whole new economy model, where we've got fintech for payments and all sorts of other kinds of technologies for companies, what skills do you think the boards require now to successfully steer through the challenges of today? Because in the past, you will find that, skill sets in terms of technology might well respectfully be absent from the traditional skills mix of directors. But today, you would argue that is even more important because you've got all the fintech changing things, you've got issues of cybersecurity, you've got issues of other forms of digital transformation going on in companies. Are the boards ready, do you think? Maybe Prue, come in on this one first.
Sure. I've always been of the belief that on the board should be independent, at least one independent director, depending on the size of the company with core industry skills. So if it's a fintech company, you'd want an independent director there to bring that skill set. When it comes to something like cybersecurity, which, let's face it, that impacts most companies, I don't expect to see a cybersecurity expert on every board. One, that's just not practical, and two, good cyber experts don't necessarily make, a good subject matter expert doesn't necessarily make a good independent director. A good independent director has to have an inquiring mind, but having a core industry skill on there, I think is that's not negotiable as far as I'm concerned. Then on the other directors, you need that mix of skill, that diversity. So you've got the diversity of thinking, diversity of thought, and challenging management. I think the challenge for directors today is to be an informed director. And so how do you inform yourself, if you're not a cybersecurity expert, to a level where you can ask and challenge management in a constructive way around what frameworks and what governance structures do we have in place to protect us? With cybersecurity, it's a case of when, not if. So it is about, and climate change is another one. You don't expect to see a climate change expert on the board. But if you're on the board of a fossil fuel company, you need to be informed about climate change risk. And so you can make, you've got that oversight of strategy. Management's developing the strategy, which the board has oversight and eventually approves with management. You need to know what's going on in that area of climate change. So this whole process of being an informed director, I think, is a key one. And it is also something that should be disclosed to investors, because you'd much rather invest in a company where you know the board has an active process to ensure that they are informed so that they can have that constructive discussion and good oversight of management and strategy.
Okay, Greg, you wanted to come in and jump in with a comment.
Oh, look, no, just to say, well, just given the comment of Prue, I completely agree that, I've always said when I was chairman of ASIC that basically any director needs to think about the business model, the sustainability of the business model, and basically they need to understand the business. They don't necessarily need to be experts on all of the risks, but they need to understand the business. And I do think the key message today to a lot of boards is to think the unthinkable. Think the unthinkable. What happens if you have a fundamental shift? Because as we're seeing today, it's happening much faster than we've ever seen before. And we were talking about finance a minute ago, that's just where I was going to make a comment. Well, somebody who's 30 years in investment banking, the one thing I think to watch on, say, banking is to look at the new Ant Finance model out of China. I think that's a sort of perhaps a pose of the future, because it does embrace digital and embraces artificial intelligence, but interestingly, it doesn't involve actually themselves actually lending money, but actually using the banks. So, I think you've just got to watch the way things are evolving to see whether a particular trend is going. And I think you've got to understand, as you said, the sector.
Okay, great, thank you. Sok-Hui, I saw you nodding a lot in terms of some of the comments. So maybe you come in on this point about, board diversity and the skills required, especially in that whole digital discussion.
So I like Prue's comment about being an informed director, of having this diversity of views, of thoughts. But I think also more importantly, to have a culture within the board where there's openness to speak up and to challenge, and to for everybody to accept that there is a healthy a board and management engagement. I think that is actually quite important. Although I would say that for a company that is actually very digital, it serves our interests. So we have a technology person on a board. We look for people who have done consumer digital marketing and have served in big markets like in China and India, so that they also can offer a perspective of the strategies when we place it before them.
Okay, Suda, what's your perspective? And obviously SGX has evolved to be a very digital company dealing with a lot of data at this point, notwithstanding, some of your traditional business might have come other ways.
Well, not fintech specifically, Melvin. We like to think of ourselves as fintech before that term became fashionable, since we are in financial infrastructure. But there is value in all dimensions of diversity. So clearly, I think recruiting directors with technology skills these days is really more the norm rather than the exception. But to Sok-Hui and Prue's comments, it's really about the culture. If you have a culture of openness and you ask the right questions, you can always recruit the subject matter experts, and you can buy expertise to come and supplement the board. But having the knowledge to ask the right questions, I think, is important. And I think the board should take a full balance of skills, knowledge, experience, and diversity of perspectives appropriate to the company's business. And certainly, this is not going away; it's just being accelerated.
Okay, Nai-Seng come in with a point of view. Obviously, you advise a lot of clients, and some clients are here, some clients are elsewhere as well. When you look at it from the perspective of board skills mix in regards to digital and technology, how do you think boards are ready for this or not?
I think certainly having that diversity and the openness is extremely important, particularly the openness to recognize that the board may actually be lacking in certain skill sets, and therefore actually actively looking for the right people to incorporate or to bring into the board. Alternatively, to actually look for avenues, right, to get education on the particular topic. So there are many channels out there that are available. SID particularly does a lot of training as well. So these are all different channels in which the board can actually sort of raise the game even higher and then pose an effective challenge to management.
Okay, maybe this is a point where I'm still looking for some questions coming in from the Q&A box. Not quite there yet, but I will maybe pose a question to Prue. This is about managing for the short term. So, many organizational policies include things like remuneration packages. These perhaps arguably can encourage boards and management to really look at the short term. What's your take on this?
Yes, look, I agree with that. And I've been looking at the issue of remuneration, I hate to say this, for nearly 25 years. And it's developed into particular, I look at the Australian market and also in Asia, in Australia, it's quite a complicated process. And shareholders have to vote on a remuneration report. I look at the types of metrics that companies choose. You might see earnings per share is a very common one. A company can have 3 years of earnings per share growth and not exceed their weighted average cost of capital. All sorts of manipulation can go on with accounting measures. In fact, a company can grow EPS by acquisitions funded by debt. And I've seen quite significant payouts go to executives and then for the whole thing to fall into a heap a few years later. Some companies are now starting to introduce sustainability measures. That hasn't been very successful. I'm not opposed to sustainability measures. Only last week, an Australian company, AGL Energy, introduced climate change metrics into their long-term incentive, and shareholders gave it a resounding no thank you, partly because I think a lack of understanding on the investor side and the challenging nature of those performance metrics. What we're seeing in the UK, though, is a move to what's called restrictive stock units, or RSUs, which is equity that's granted without performance metrics that vests over a very long time, up to 7 years, and also for the senior leadership team, so that would be C and C-1, that there would be what's called post-departure vesting. So they're really exposed to the stock. And I think what boards are finding is that that's simpler for the executives to understand. It's simpler for shareholders and investors to understand. It's much easier to communicate, and it really does align the senior management, the senior leadership team, with the growth of the company, or with the results of the company. But it's a very, very difficult and complicated area, and I don't think there is a silver bullet for solutions. It is some companies might be going through a turnaround, and I think with COVID, maybe there does need to be some short-term focus to get companies out of the impact of COVID, and then reassess the remuneration plan once you're out of COVID. And the problem with issuing equity now in the middle of COVID, that share prices are quite down, so there'll be more equity issued. So it is a complicated area and a real challenge for boards to approve and come up with structures, and for investors to understand, and also other stakeholders to understand.
Okay, I hope this is a simpler question, not so complicated, but I'm conscious that we probably have about 5 minutes left of the session. I just want to ask the rest of the panel whether you've got any comment to what Prue has just said in terms of that issue of remuneration. Just jump in if you wish.
Yeah, Melvin, can I say something?
Yes, please.
Yeah, so I wanted to also reflect that we talk about EPS, we talk about some of these very quantitative metric, and at least our board, we're in a camp of we don't focus on one particular financial metric, and that's healthier. So we go with a sort of a comprehensive scorecard, which has served us well. So our scorecard has short-term and long-term performance measures. The short term is weighted only 40%. It looks into account a number of shareholder metrics, how you perform on the risk management, audit, compliance rating, customer feedback, employee feedback. So even of that 40%, very little weight goes to performance per se. We do 20% on digital. So how much progress you're making on your digital is quite a complicated scorecard. And then at the bottom, we have long-term initiatives, 40% weight. And we have 20 initiatives every year that we say are very hard to do. Multi-year execution is required. But if we do those well, then they translate into revenue streams in future year periods. So we find that that is actually a very good way to balance the long-term and the short-term. And the board sort of does an assessment of how we perform on the scorecard, and our bonus has a calibration to that. So after you calibrate, of course, the usual thing, right? You actually will spread it out over multi-years, and all the shares sort of restricted shares will only vest 4 years into the future, etc. But I think the starting point of how you even come out with the reward itself, I think reflecting a balance of short and long-term measures are actually quite helpful.
Melvin,
Sujat, come in.
Yeah, not specifically just on the remuneration question, but also what we discussed earlier on sustainability. I thought what Prue mentioned about the Aussie company that voted no to putting some of these long-term climate change measures was a very important point, because it's really what for public companies, the shareholders want. And how do we align the interests and educate shareholders, get the right type of shareholders for the right type of companies in order to get that balance. So we can talk all about sustainability, and quite frankly, a lot of the examples of failures of ESG are negative impact examples. But if the market is willing to pay a price, if there's really the wall of money that rewards companies who practice sustainable practices, good ESG, there's a lower cost of capital, then companies will move down that line. Shareholders, there are short-term ones, there are long-term ones. Being able to survive the short term, as I mentioned earlier, is critical. But it is really about being able to communicate and align even the short-term shareholders to recognize that whilst they are important in providing liquidity in the short term, which is what's required for the long-term investors to come in and invest and get comfortable at the company, it is really about the long-term goal that the company is able to articulate well and keep that balance of achieving short-term liquidity and funding support, and be able to therefore drive its mission for the longer term. Not easy to balance, but it's about communication, and it's about bridging the different types of shareholders and their needs.
And that's great, Sutat. Thank you very much, because I was just about to close the session by asking all of you for just one key piece of advice to leave with our attendees today, and on this whole issue about balancing short and long-term business pressures. And Sutat has very well given that one-liner, literally in his last sentence there. So I'm just going to go around the block and ask the others now. Maybe we'll go with Greg first, and then we'll finish up and we'll go around. Right, Greg, come on in. What is that one piece of advice you will give?
I'd basically say, as I said before, agility, scenario planning, and think the unthinkable, and tail risks.
Indeed. Thank you, Greg. Nicing, what do you reckon?
Agility.
One word. Well done.
Yeah.
Prue.
Well, I'd like to agree with what's just been said, but add on to that sound communication. Because without communicating that, without investors understanding that, without other stakeholders understanding that, the benefit won't be achieved.
Indeed, you can say, do as much as one, but you don't tell people, they wouldn't know about it, right? Sok Hui, one last thought.
Business model sustainability.
And what does that mean in a nutshell?
It means that you have a business model that will sustain over the long term, because people will pay for your services, because it is what is needed by the market.
Okay, thank you very much indeed. So folks, as always, you know, time is never on our side. We do have to call a close to this session. We did promise that it will end at 5. It is on the mark now at 5 o'clock. So to my panelists, thank you very much indeed for sharing your excellent views and thoughtful insights. To everyone attending, especially for your questions, very sorry for a couple that we haven't been able to get through in the time that we have, but we hope you've managed to get some good takeaways from this session and points of view to support both your professional roles and maybe your own developments as well. So till next time, have a great afternoon and an evening there, and thank you very much indeed.